Alrighty, everybody. Good afternoon here. It is January 2nd. I am Marziti here with the Bullish Bears, and we're going to do a discussion about. Um, we're going to do a discussion about the 2025 long-term holding ideas. Everybody and their brother is coming out with predictions. Everybody. We've got some people saying that we're going to the moon. Bitcoin, this and that, and all this kind of stuff's going to the moon. And then we got other people saying, oh, we're due a 10% pullback. Oh, the technical indicators say we're going into the gutter. All this kind of stuff. And so we have to say, okay, look, first of all, we have to disconnect ourselves from all the speculation. We have to disconnect ourselves from all the speculation because everybody's got some kind of an opinion. And yeah, we can look at the long-term options flow. We can look at this. We can look at that. But, okay, yeah, let's see. Let me acknowledge that. Thank you. Okay. So we've got all these people putting out predictions. And it causes a lot of anxiety and a lot of confusion with folks that they just don't know where to start. And I admit, I'm just as bad about it. Years ago, I used to use one of the big firm holdings houses to handle my long-term investments. They did a crappy job, quite frankly. And they came up with lots of excuses and all this kind of stuff. And eventually, though, they were making, my agent at the big long-term fund people, just decided to kick me out of the clubhouse. They just basically said, you know what, we're not interested in. And it's not that I was being a jerk or anything like that, but, I did question them and so forth. And a lot of it had to do with my agent. Her business had grown big enough, and she wanted to deal with people with tens of millions of dollars and all that kind of stuff, and I just wasn't big enough, and she just said, I'm kicking you out of the treehouse. So I ended up having to take over my long-term holdings myself. Now, I had tried that once before, years ago, and it was a disaster. I didn't understand price action. I didn't understand this, that, or the other, and it was a disaster. So I was a little nervous about taking it over myself. But I thought, well, I'm a little more educated now. I know a little bit more. So let's see if I can do a better job of it. And yeah, I have. Now, I continue to learn over and over and over. Now, there are a lot of people that their sole thinking is simply to buy it, hold it, forget about it. They do dollar cost averaging where they, if you have a 401k, for example, at your job, and you're contributing to it, they, take money from your check every pay period. They put it into your 401k. They don't care if the market is going up or down. They just put the money in it over and over and over. That's dollar cost averaging, buy and hold. And, yeah, they rebalance it. They do, the company that administers the 401k will sell some of this and buy some of that for us, and that's good. But the point being is that the idea with these 401ks, unless you're going to self-direct it, they're not interested. They just throw your money in it, and they figure that 5-10 years from now, you'll have a lot more than you do today. And there's something to be said for that. It does work. It does work. But you may be the kind of person that's like, I hate the ups and downs of the markets. I hate this and I hate that, blah, 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 blah. Well, recently I've been doing some study into something called correlation, and so that's where we're going to go with that. Let me go ahead and get started here. First of all, the disclaimer, I am the creator of the presentation. I am not a financial advisor. It's for educational purposes only. My viewpoints here are not necessarily that of the Bullish Bears community or anything like that. You are responsible for your own trades, and you're welcome to redistribute this. After I get it done, I'll upload it and post the video if you guys want to review it. So let's start with our topics here. First of all, we've got lower expectations from the big houses like your Goldman Sachs and places like that. We're going to look at some of that. A little bit of talk about ETFs, stocks, correlations, history of growth with correlations, and so on as we go through that. Goldman Sachs has forecast 2025, 10%. You know, we've had these years where the S&P has gone up 20, 30%. Well, they're saying they're not projecting these 20, 25, 30% returns on the S&P. They're scaling it back to about 10%. As you can see, it says right down here, they're calling for about 9%. Morgan Stanley, S&P is up 28% this year, but they're expecting 5 to 10 next year. So it's still bullish. Yes, it is still very bullish. But I think a lot of this ties into the fact that we have a strong segment of the market saying that we are overextended. Price to earnings is grossly overextended. We're due for a major pullback, some saying 10%. So if we have that pullback, well, then that obviously offsets. If we don't have that pullback, then you say, yeah, we can have that 20% run. If we do have that pullback, well, of 10%, well, then 20% drops back to 10%, and that lines up with what they're saying here. Of, you know, around 5, 10, 15, or whatever percent kind of a gain. So I do kind of, in the back of my mind, constantly think about this big pullback that everybody is expecting. And if you look at the charts, there is, you know, we never want to call the tops and bottoms, but, you know, definitely we could see key points that if we do roll over, we kind of know where we're going. And we'll look at that later if we have time. So, long-term investing, stocks versus ETFs. The good and the bad to stocks, wild swings. They can go crazy wild. They can also crash and burn. And when you build your portfolio for growth, notice I'm saying growth here as opposed to income generation like dividends and things like that. But when we're building our portfolio for growth, we're exposed to a lot more higher volatility. And some of the stocks that we choose in the hopes that we will get that growth can have that higher volatility, and we can see these 5, 10% moves in a stock in a day. And we're like, oh my gosh, and you want something that gives you indigestion real quick. You go in, look at your portfolio, and oh golly, Tesla's down 10% again. But they can also go up 10%. And so we really have to be kind of picky on our entry points, and we'll talk some more about that as we move along. ETFs, of course, are not as volatile on a daily basis. They're more trendy. Not all of them, but in general. I'm just making a very broad comment here. The ETFs can be a little bit smoother. They also don't have, because they don't have to deal with the earnings, they're a lot of times more sensitive to just general news. So they're more sensitive to general news, is their replacement for earnings. And that's a good and a bad thing because we only have earnings on stocks every quarter. ETFs have to face news every day. The other downside, good or bad, with ETFs is they're weighted to favor the larger market caps. In other words, your Microsoft, Apples, Amazons, Nvidia, stuff like that. And I was having a chat with a friend of mine the other day where he commented that he said, but they factor these kind of things in. 'Cause I was saying to him, I was like, If you look at the SPY, the top four hold over 20% weight against the other 495. And he says, yeah, but the fund managers understand this and they weight it correctly and all based on the risk parameters and all that. And I'm like, well, okay, he's got an argument there. Nonetheless, we're very dependent in things like the SPY and the Qs on that top 10. ETFs also have an expense ratio, and some of them are reasonably cheap, like the Vanguards and some of the SPDRs and the Spiders and all that. We'll look some more at that as well. So you've got some pros and cons, but maybe the right solution is a mixture. A mixture. But let's take a look here. As I mentioned here, here's the SPY. Here's the top holdings of the SPY, and the top five, the top five of 500 hold 20%. 20%. In fact, the Qs are very much the same way. SMH is the same way. And so, there are equal weighted ETFs like the RSP, RSPT, if you want an equal weighted version of the Qs. They don't perform as well, but they're, a lot smoother sailing in many cases. They're not as volatile as the SPY or the Qs. Again, we'll come back to more of that kind of stuff here. But interestingly, something that I learned recently that really got my gears moving, turning and grinding, is this idea of correlation. Now, first of all, correlation is a study that goes from -1 to 1. A -1 means that two things move completely opposite of one another. A 1 is when they move together completely identical. So you could say that like the SPY and the Qs are very close to a 1. Because let's be honest, if you compare their charts side by side, matter of fact, we can do that. Let's just go over here and let's put the SPY on one side and we'll put the Qs on the other side. They're almost identical because they're heavily correlated. And you say, well, that's good, right? Well, yes and no. On the yes side, if one goes up, the other goes up. But on the downside, if one goes down, the other goes down. So you say, well, then why bother buying both of them? There's no particular reason to buy both of them if they're that correlated. There's no reason to have both necessarily because one's going to do basically what the other does. On the other hand, you can get these negative ones that move exactly in the opposite position. Well, the problem with exactly in the opposite direction would mean you're always net zero. And you think about that. If one side goes up 5%, the other side went down 5%. Well, add them together, what do you get? 0. So we don't want that either. But there is a middle ground called 0, and that means there's no correlation. They move completely independently one of another. No correlation whatsoever. Sometimes one is up, sometimes one is down. They just do their own thing. And that is something important to us. That's something very key. Because down here at the bottom, you see, do we really want all of our holdings to be correlated? Well, if everything is a forever bull market, yeah, that's a great idea. But it's not. We have pullbacks and we have bear cycles and this, that, and the other. So is there a way to find growth without so much correlation? And that is the point of my topic today, is to say, can we find growth without correlation? All right. So where to start? We're going to pop over to Thinkorswim. We're going to create a custom scan. And in that scan, we're going to look for both growth and, I've made this word up, uncorrelation. For those of you, like I said, this will be recorded. You can screenshot this right now if you want. Um, you're welcome to screenshot that if you want that Thinkorswim study, or you can type it, so you can type it in. It's whatever you want to. I'll give you a second to do that if you want. But I'm going to take you over to that study. We're going to go through it, and I'm going to show you what I found. Okay, let's pop over. Here is Thinkorswim. Now remember, all right, so I've got some of the things built into Thinkorswim, and then I've got two customized scripts in here. You must have a live Thinkorswim account in order to run the customizable parts of these scripts. If you're only on paper, you cannot run these scripts. So, and if you want, okay, it's decorrelation. Okay, thank you. I see that signet. Appreciate that. All right, so let's talk about my base stuff here. First of all, I'm looking for stuff that's at least $2 because I'm not really interested that much in the penny stocks. Okay. I want billion-dollar companies. I want to see that they have intraday volume of at least 1 million shares on the 21 and on the 200. This tells me that they're liquid, they're big enough, people take an interest in them, that kind of thing there. I don't want real small traded stuff myself. Now, this is all personal decision. These are my criterias. And if I'm looking for stocks, especially when I'm looking for my entry point, I don't want to buy near earnings because of, it could go up or it could go down. And I'd hate to buy something and it immediately tanks on me. So the first thing that I'm going to do, so that's my base. Except we're going to look here. This is on a monthly. And I have this script right here. Now, this script basically says, generally walking through it, what I'm looking for. The summary of this script is I'm looking for companies that have an average growth of at least 5% a year for the past 5 years. Average. Now, you could say, well, why don't you just take the price from 5 years ago versus today and see if you got, 15% or something like that. And yeah, you could, but what I really am looking for is I want to smooth it out. I want to see it 1 year that it had that growth, 3 years, and then 5 years. Now, the reason for that is I don't want to see that they had this huge rally. They lost money, and then in one particular year, they just had a huge, massive growth rate, and now they're back to losing money again. So I'm sampling 3 time periods, and I'm averaging it out. And that's kind of what I'm looking for. Another reason for the 5 year is it catches COVID. We will be losing that particular thing here soon enough, but for right now, we're still a little bit in the window of COVID. Another thing also is I average, like for the last year, the 11th, 12th, and 13th month instead of just saying 12 because I want to average. So I'm looking for averages here. So this whole thing is built around averaging. And then I'm going to go through here and ensure that, we had that growth in the 1 year, we had that growth in the 3 year, we had that growth in the 5 year of the exponentials here as we go through that. I want to filter out this particular part right here is to filter out for companies that have had ridiculous growth because it's not maintainable. It's not sustainable necessarily, so I don't want people that are just crazy out there, all right, with their growth. So these are companies that have grown. and show a pattern of growth. Next in my scripts is very simple. I'm doing a correlation against the SPX. By default, with correlation, unless you say otherwise, it goes against the SPX. I'm looking against the last 52 weeks. So now remember we said that correlation goes from 1 to -1. 0 is ideal. So what I want is to catch that zone where the correlation is less than 0.5 but greater than -0.5. I want to catch that sweet spot where we maximize. I could just simply say put it around 0, but I need, we've got to give it some wings, some areas there to capture these companies that have grown regardless of what the SPX did. And that's important. These are companies that have grown regardless. Well, these are companies decoupled from the SPX, but when we add it to the growth, what we now have are companies that have grown regardless of the SPX. Now, I hope you get that idea, because that tells us, you say, well, why don't you just get the SPX, the SPY? Remember, we talked about how heavily weighted, and we'll come back to that, how heavily weighted the SPY is towards the Magnificent Seven kind of stuff. And, it's just the way it is. So we're looking for companies that, and ETFs. You'll notice here, I've got this line right here. This is SOXX, iShares Semiconductors ETF, is decoupled from the SPX, yet it grows. It has grown by itself as well. Okay, so we'll just refresh the scan so that you can see it. That was the actual results, but actually I got 21 now. I had 23. Somebody fell out. All right, so what we have here is 21 stocks and or ETFs, because there is one ETF in here, that has grown by at least 5% every, on average for the past 5 years. Now, granted, 5% is nothing great. Okay, that's fine. I get that, but it's a place to start. It's a place to start. And you'll notice over here we've got quite a few categories over here. We've got IT, discretionary, industrials. We've got some energies, communications, and just a nice, very nice variety of our various sectors. Not every sector is necessarily here. I have a thing about real estate. I just don't want to mess with real estate. It's number one, it's pretty volatile, and I still never have resolved the idea about do you get K1s on real estate stocks, and I don't want to mess with that. Anyway, so all these have got they're all at least $1 billion company. They all average volume, maybe not necessarily today, but they all have a good average volume. Some of these pay dividends, and some of them pay very nice dividends here, like Darden Restaurants pays 3% dividend. Not bad when you consider that it's a company that's growing, decoupled from the SPX, and has a dividend yield. Very nice. EOG, I have no clue who they are. We can certainly go look them up on Seeking Alpha, or maybe even within Thinkorswim here to get some ideas. Now, understand that this is not a list that I'm just going to say, okay, done. No, we're going to actually have to ultimately go and look at all of these to see, because we also got to say, number one, is it something of interest? Number two, is it a good time to get into it? Now, take a look. This is where they are with their moving averages. All of these here, not all the reds, but these here, are, let me zoom in on that, under their 200-day moving average. They're under their 200-day moving average. That is a very interesting place to go look for a buy. Very interesting place to go look for a buy, because that can be a pretty good place to pick up something. Again, not saying that's an immediate recommendation. We still have to go look at it. On the flip side, we've got a couple down here that are above their 8 moving average, and we'd all go take a look at them. This, as we'll come back and talk about more in a minute, is 5-year price. Understand that price is not the same as return, because return is price plus dividend. Let me say that again. The price is what you see on the chart. The price is what you see on the chart. The return is the price plus the dividend. I am only interested in the price. So be very careful when you go to a stock screener and it says the return is, because we need to subtract out, if it has a dividend, we need to subtract out the dividend to see, is the price growing? We'll look at that some more later. Okay, so all of these here, now take a look here at CrowdStrike. I can immediately tell you I wouldn't touch CrowdStrike with a 10-foot pole. Why? Not right now anyway. If you remember earlier in the year, absolute disaster with them. They gained a lot of prominence, and then they had that blue screen of death thing that happened on everybody's Windows computers because they rolled out a security patch that just crippled the airline industries and companies all over the place. It was just across the U.S. There were just blue screens everywhere for a lot of the big companies. So I don't know that I want to touch that. It's still a little volatile. And as you can see, there's plenty of other IT groups in here to choose from. So again, we still have to use a little common sense when we screen these kind of things out. Here's my tally. All tally is simply averaging the returns for the 1 year, 3 year, and the 5 year. That's all. It simply averages the returns, the price. I said that wrong. Averages the price change of the 1 year, the 3 year, and the 5 year. So what that is telling us here is, for example, ING, and I don't know who they are, necessarily doesn't matter, but it's saying that their average return for those 3 periods sampled is 30%. Okay, 30%. Here we've got some here, like here's Chipotle. There we go. A lot of people know Chipotle has had a 120% growth, because 1 means even, averaging over the last, that sampling of 1, 3, and 5 years. Very nice, very nice. Dell, that's a company that a lot of people just like, who talks about Dell? Well, Dell's still big in the corporate space. Still very, very big in the corporate space. So we see a lot of that. So I've got, looking at their price for the 5 year, the 3 year, the 1 year. What I would be, and looking at the 3 month, for example, we take a look here, we can see that First Solar, and I know Signet talks a lot about the solar sector here. Here's First Solar. For the last 3 months, they're down 20%. Now, again, we have to consider the bigger picture. Trump's coming in. Trump is more pro-oil than he is pro-green energy. So that is one thing that may not be a positive. But when you look at this, unless there's something broke about this company, we might look at taking, that's very interesting to see that this could be a good entry point on it. But again, we need to back out and look at the higher time frame. And the little chiming that you're hearing in the background is my wife coming in. She's been to the store and she keeps walking past the motion sensor. Sorry about that. No big deal. Anyway, so but you see here it's below the 200. We see that it's dropped 20% in the last 3 months. And, so now we step back and we look at the broader market and we say, okay, now we got to deal with the whole Trump, oil and gas and stuff like that versus clean energy and how that could play out. If you think that clean energy is going to take a dump next year, well, obviously, then First Solar's off the table. On the other hand, if you still think it's got a lot of life in it, this possibly could be a fantastic buying spot on it. Again, we'll take a look and see. So again, just very quickly reviewing this, we've got stocks of a minimum size, minimum market cap, billion-dollar companies. They've got to have daily volume. They've got to have grown in the past 5 years. They don't have earnings coming up, and they are decoupled from the SPX. So saying that regardless of what the SPX does, these stocks show a history of growth. And of course, we know that history, as great as history is, does not imply, the old thing, historical performance is no guarantee of future results. But this is definitely a nice list to consider for our starting place. Now, let's see. Is there more that we can add, though? You're saying, well, okay, all you got are stocks here. You don't have any ETFs here. Well, let's think about that. How come there's not that many ETFs here? Well, this correlation is against the SPX, right? And we've already shown that the Qs look just about identical to the SPY. And maybe, well, not SMH, okay. Surprisingly, no. But when you look at a lot of your ETFs, they look very similar to the SPY, don't they? Now, granted, SCHD is in the short term really headed off, but up until, if we just look at this recent trend here, SCHD and the SPY were walking hand in hand. So the reason, and so many of these ETFs are built on the same growth. And when we go look at the holdings of many of these ETFs, you'll see it's the same thing. So naturally, their growth, their charts look almost identical, and therefore the correlation part of our script here kicked them all out. Because we are looking for things that are going to grow independently of the SPX. All right. Now that doesn't mean that we're not going to take the SPX or the SPYs and the Qs or stuff like that. That doesn't mean that at all. It just means that we're looking for, you say, well, what's the big deal? Let's say that you bought the SPY. Let's say that you bought the SPY, great. But wouldn't you like something that shows an independent growth factor if the SPY turns south? If we have that big 10% pullback this year, if it happens, it might not, we don't know. But if it happens, wouldn't you like a good percentage of your portfolio to still keep growing? Possibly so. Very possibly so. Even though you may have be holding the SPY and it's, in the crapper, you still may have 50, 60, 70, 80% of your portfolio is growing anyway because of this diversification. And that's what we're trying to accomplish here. And in fact, let me just kind of show you. Here is a list that I compiled. Now, this list has actually got more stuff in it because there's more stuff I want to show you that I added to it. But because I'm going to add the top holdings of the SPY, and I'm actually going to hold some of the SPY itself. But look at this here, and let's get rid of that. This is what I'm after. The S&P is red. And over the last 5 years, it's showing that it grew 80 some odd percent. But this portfolio that we're building here is 300%. because of the independence of it from the S&P. You know, so many people are looking for things that compare. They scan for stocks that outperform the S&P and stuff like that. And the answer to here is no, that's the wrong approach. We're looking for things that are decoupled from the S&P and grew anyway. And so that is why over the last 5 years, this portfolio that I'm looking at here grew 300. Now, you know, how great would it have been to been in these things back here? But look at the growth versus the S&P. So even though the S&P has been growing and growing and growing here, and here's COVID back here, a portfolio that is uncoupled from the S&P, which shows a history of growth regardless of the S&P, grew more. That's what I'm after here. That's what we're after. Okay, now, so we've got a list like this here. And I'm not saying that every one of them here is actually on the final cut. But, oh, and there's another thing too here. If you opt to do something like this here, this kind of scan, another thing that I did is I saved this list, and then I went to the monthly, and I went to the 36 for 3 years. For 3 years. And sometimes that can give me a different result. In fact, I found I had different results. Now, this is something you've got to ask yourself of, is this something that you want to set and, you know, you're just going to check it every quarter, every half year, or whatever? These are not necessarily the same results. You'll notice CrowdStrike is not here. CrowdStrike did great this year. It ain't done great over the last 3 years. It ain't in this list. Neither is Chipotle. Okay. Let's go back even more. So I took these results and I added those. And then I went back 5 years. 60, okay. And scan. Now I've got an even different. Now they're going to have some things again in like Gilead Sciences. I keep seeing that one. That one keeps showing up. And I think Comstock here also, I recognize that one from some of the other scans. But the point is now I've looked at it from a 1 year, a 3 year, and a 5 year. And by looking at that, I have now built a master list. To start with, again, I'm not going to take all of them. There's no sense in taking 1, 2, those are mines. Yeah, you know, you're going to see a lot of gold, for example, show up here. So there's no sense in taking 1, 2, 3, 4, 5 gold companies because they all do the same thing. They're all going to move the same. We're going to whittle this list down. So we're definitely going to whittle this list down. So I took the results from the 1 year, the 3 year, and the 5 year. Put it all together. By the way, if you are if you know anything about spreadsheeting, you can so all I got to do here is I click here. I do a Control A to select all. Control C to copy. We can come over to a spreadsheet. Control V. And there's my tickers. Now I can just delete the rest of these columns if I want or whatever. So if you've got a third-party analysis thing, a portfolio thing like Stock Rover, Morningstar, Seeking Alpha. This is a quick and easy way for you to export all those here, and then you can just import those in there. So I took the 12-month, copied them over. Then I took the 36-month, copied them over, and I took the 5-year ones and copied those over. Then you say, okay, well, all right, but we don't want to miss out on the Magnificent Seven and all that. All right. So let's just go look at that. So here is on Seeking Alpha, but you can get this anywhere, a lot of different places. Here's the SPY. And we can see over here their top holdings. Apple, Nvidia, Microsoft, Amazon. Notice, by the way, I don't know, I never thought about this until today. They have Alphabet Class A and Alphabet Class C. If you look at the charts of them, they're 99% identical. The difference being is that Class A, if you buy those, you have voting rights. If I understand this correctly, if you buy Class C, you do not have voting rights. Something like that. But when you add the two of them together here, 2.25 plus, we'll call that 4.25, not quite. So we'll call it around 4%. So just in Google is actually, they hold more Google than they do Meta because they hold two things that are practically identical. But at any rate, so why don't we pick up the top 5 here? We're 5 or 6. 1, 2, 3, 4, 5, 6. Maybe, Google, AVGO. So we can do that. We can add those to our list. That's not what I'm trying to do. I am, no, I'm not trying to do that either. Stupid thing. Go away. Hang on. Let me get my screen. There we go. I hit the wrong key on the plus and minus business. All right. Here's the Qs. You'll notice the same thing with the difference of Broadcom and Costco. And Amazon. Yeah, Amazon is in the Qs, but not in the top of SPY and all that. Okay. So you've got some things now. So we could add Apple, Nvidia, Microsoft, Amazon, Broadcom, Tesla. We could add these things to our list as well. All right? Now, you say, well, why would you buy those instead of just buying the Qs? You can buy both. You can buy them individually or you can buy them both. It's totally up to you what you want to do here with things. Absolutely, totally. Let's pick another one. SCHD. Big name known for the fact that it's a dividender. And you can just add SCHD or you could add just their holdings. This is interesting because you may like, hang on, I'll show you one. Let me make my point right here. I think it's BIZD. Yeah, Van Eck Business BDC. Let me show you something here. Where is it? Yeah. This is not a typo. If you look at that, you'll understand what I'm pointing at. We talk about things like the Vanguards and all that kind of stuff having an expense ratio of 0.05. This is 13.33. You are seeing that correct. That expense ratio is ridiculous. But their growth has been really, really good. If we go look at them on the 5-year, well, okay, not so great. Well, they had some pretty good growth back here, but a lot of people really like them and say, they've got some pretty good growth and so forth. Fine. Just go look at their holdings instead and pick those up. And you don't have to pay the expense ratio. Here in Seeking Alpha, all I've got to do is just hover over it. Well, you can't see it so much, but I could right-click on it and open in a new window, and I can get the ticker symbols of all this kind of stuff. And I can just build my own ETF. Signet talks about build your own ETF. That's true. You can buy these yourself. And then you don't have to pay 13% expense ratio. Now, okay, they do their own rebalancing and all that kind of stuff, but the point being is that when you look at some of these ratios, some of these ETFs, and you see a really high expense ratio, and you're like, oh man, that's too expensive. Well, then go look at the holdings. You can always pick up the holdings. Anyway, let's just pick, I'm kind of watching the chat. If anybody else has got a particular ETF that they'd like to see the holdings in, drop it in the Discord chat. I'll be glad to bring those up, and we can look at that. But, you know, not everybody's got the Seeking Alpha. It's a good platform. I do like Seeking Alpha. You know, obviously you have to pay for it. I've done some stuff in the past where I've shown using Stock Rover. Stock Rover is a stock ETF bond screening kind of thing for spreadsheet junkies. If you're a spreadsheet junkie like I am, you love Stock Rover, because you can go over to a screener. Here they call them screeners. We'll call them scanners, whatever. And just the stuff you can ETF bonds. Let's go look at that and modify the screener. The things you can put into this for your screener are incredible, absolutely incredible. The only downside to it is, the only reason I'm not using it for this particular presentation, especially today, is because it doesn't have correlation. I had to go to Thinkorswim for that. So, and in this case here, we can do everything in Thinkorswim, and that's fine. But I could certainly take my results from Thinkorswim, drop it over here under a watch list, and let's take a look. I want to actually show you that watch list that I built here. Correlation report. This is the magic. Now, this doesn't mean anything to you very possibly, so let me explain what you're looking at here. The brighter the red it is, the closer to correlation 1. Writing cat, if I want to replicate VUG. All right, just so because this is going to take a minute to explain that, let's pop over. Let me just answer your question here. VUG. Now, I'm going to go to holdings. The number of holdings, if I can, the number of holdings in VUG is 185. However, the top 10 make up 56% of it. So you could buy VUG, or you could just buy the top 10 of their holdings. The difference, the only reason that I would say not, come here, why are you not working with me here? If we go look at VUG and we look at their expense ratio, that is so cheap. Just buy the VUG. Just buy the VUG. Unless you really want to try and maximize it, that is so cheap. I would just buy the VUG. And would I be day trading these stocks also? I mean, obviously, you can day trade these kind of things, but what I'm looking for here, now the focus of today's video is stuff that you're going to buy when you get a good entry on it. You're going to buy it, and you're going to tuck it away, and look at it a year from now, or every quarter. Once a quarter, you're not going to mess with them on a day trade basis. Can you day trade them? Of course you can. But if I were going to day trade, I would be looking for, and I'm just going to deviate real quick to show this. movers. These have the same criteria, except instead of correlation, we're looking for stocks that move at least $1 a day. And when I run that, and I'll come back to everything here, but this is, I'm looking for stocks that move $1 a day at least, because I don't want to get into a bunch of stocks that just go nowhere. And it turns out we have exactly 20. And, you know, if you want to screenshot that, you're welcome to. But some of them, like, you know, remember that Goog, G-O-O-G, and G-O-O-G-L are the same thing. I mean, but these are your, if you're looking for stocks that move during, and ETFs that move during the day, these are the ones that move at least $1 a day, especially if you're going to do options and stuff. But at any rate, can certainly go into that further later on, you know, or whatever. Okay, let's get back to, but I did want to kind of answer. I hope I answered your questions on that writing cat. Let me know if I missed something on that. Let's go back to growth and correlation. So here's this grows at least 5% a year. And then we messed with looking at the 1 year, the 3 year, and the 5 year by changing this metric here. And we built us a master list. And let's run that scan again. Then we went in and we added, now you can just buy the SPY outright. You can buy the top holdings in the SPY and the Qs in SCHD, SMH. You can do the same thing in the IWM. It's a little harder in the IWM, though, because it's more equally weighted. IWM is 2,000 stocks, so, well, almost 2,000 stocks, and you just kind of see that these percentages here, so in this case here, just by the IWM. Just by the IWM. It doesn't make any sense to do that. And again, you still need an entry point on all this kind of stuff. But anyway, you get the idea. All right, so we built this big ass master list. So then I imported it over here to something like Stock Rover or any kind of a website. But what I'm trying to get to you here to show you is this correlation. We were talking about that. The redder it is, the more correlated it is with the SPX, with SPY. So now, and I can put a filter on here. Let's just put a filter on here, and I'm just looking for things that are .75. Meaning, remember, it goes from 1. 1 is 100% lock and step correlated, so .75 means it's very, very correlated. So if I do that, all this other stuff is blanked out so that I can just quickly visually see. I can see that ADI, analog devices, is very correlated with KLAC, KLA, because they're both semiconductors. Now, I still may want to keep them. That's fine. Notice all the white space in here, though. We have a very, very uncoupled portfolio. And all these stocks grow. These are all growers, but they all grow independent of, well, with the exception of some things like, I forgot I still have some crypto in here I needed to take out. But at any rate, all these have grown independently of the SPY and the Qs. And that's the beauty of it. So now obviously we can see here that SMH has got a lot of correlations. And so that's an ETF. So it's probably going to be heavily correlated with some of its holdings. Here's AMD. AVGO, Broadcom. And if we, we can scroll. It's kind of hard to see this. Let me back out. See if I can get this to work so we can see the whole sheet at one time. I think they keep resizing it. No, there we go. All right. There is the entire sheet all at one time. Now understand that you've got AMD going down, you've got AMD across, and where they intersect is where these ones are. That's where where they intersect. However, what I'm looking at here, let's just go, ooh, this is tiny. Let's see if I can, done. All right, these are the things that are at least 0.7 correlated. So a little bit heavier correlation here. So you can take a look at a map like this, and you could say, well, am I too correlated? Am I too correlated? If I see too much correlation in here, then I start looking for a column or a row that has too much red in it. So let's just take a look at this column here. I've zoomed in so much I can't, zoomed out, I can't see anything there. What is that? C, D, or whatever. I'll zoom in on it in a minute. But you may say, this thing has got too much correlation with other stuff, so some stuff has got to go. And this is where you'll start to see things like, well, golly, we got 3 gold companies in here. I only need 1. So let's go look at the 3 gold companies, find the one that does the best, and pick it and trim the others. Or automotives or whatever. I don't need 3 companies that do the same thing. I don't need 3 companies. I'll keep 2 in case one of them has some bad news. CEO caught cheating on his wife. Stock goes, meow. So I may keep 2 gold companies. But I don't need 5 of the same thing. Okay? Y'all get what I'm saying, I hope. All right, oops, that's not what I wanted. I want to do that to get me back to normal. At any rate, any questions so far? Does everybody get the idea? These are stocks and ETFs that are growing. They're growing. Most of them, because we did add AMD. We did add NVIDIA. We did add all those after the fact. So we started with our list. We started with our decoupled ones. Then we added in the top stocks from the Qs or the SPY or whatever. The Qs and the SPYs, maybe SMH, maybe SCHD, stuff like that, to build us a big portfolio. Yes, we're going to have some correlation overlap. That's fine. But the point being is that I don't want just horrific amounts of overlap. Let me give you an example of that. One second. Watch list. Here's stocks, best of the best. I've not seen this. I don't know the results. Okay, well, it's a small list. That was kind of disappointing. Let's go to screeners. I don't know. I'm looking just to see if I can find. Anyway, the point I'm trying to make is that there are some correlation maps you can go to when you compare a couple ETFs. Pardon. If you compared the SPY against the Qs, you would see, and matter of fact, here, I'll show you. Interesting site I learned about the other day. It's called the ETF Research Center, etfrc.com. The free version lets you compare 2 funds. If you go for the paid version, which I do not have a paid version to it, but you can upload your entire portfolio and it'll tell you how much overlap that you have. Not correlation, just overlap. But here you can see I've got the SPY versus the Qs. You can see that they roughly have, let me just double check that. I didn't think that was right. Let me refresh that. They roughly have 50% of the same stocks. Now, I'm not talking about correlation, as far as lockstep, but they are going to have a lot of correlation because they got 50% of their stocks overlap, which means 50 out of 100 stocks on the Qs are also on the S&P. So there you go. All right, where are we? I've got about less than 15 minutes to wind this down because Cygnet's got his stream coming up. Okay, so we've talked about that. You could hold the SPY and the Qs. You could hold, and remember, if you hold the SPY and the Qs, you're doubling down on that top 50%, on that 50 percenters. So you could just buy more of the SPY, whatever, if that's what you want to do. Signet says he is not. Oh, Creed, you're right. I've got my whole week messed up. I've got my whole week. Everything is messed up. I keep thinking it's Wednesday or something. Okay. Anyway, well, Creed's coming on in about 15 minutes. All right. Dividend payers, real quick. Remember, 3 types. Growth, high-yielding dividends, bonds. And remember that returns are not the same as price because the return is price plus the dividend. And it is possible that you can see that a return is positive but price is negative. I'll give you a perfect example. Let's take a look at YieldMax. You guys know YieldMax, right? Oh, yeah. They pay 34% dividend. 34% dividend. Man, they just rock it. Wait a minute. Their price back here was $19. Their price now is $17. They fell $2, and yet their return is going to show 30 some odd percent because the dividend is greater than the change in price. Now you say, well, that's still a good thing though, right? You're still making money. Well, but here's the thing. If the dividend is that much greater than the price, if the price is not going up, or at least flat, they're taking your capital money and giving it back to you and calling it a dividend. Now, just make sure you understand that. I give you $1, and you give me, let's say, 30 cents, and you tell me this is your dividend, but I look over there and say, well, wait a minute, though, my capital is only 70 cents. Well, you say, well, okay, so you're just getting your own money back, so that's not a big deal, right? Except you're taxed on that 30%. It's called ordinary income. Dividends are taxable. Now you realize you're losing money unless the dividend is that much greater. So you got to get into all kinds of math now. So when you see these big things like YMAX coming out here screaming about 34% returns, you got to go back and look to see what the price is doing, because here the price is falling. And so 34% actually may come out to be 10% because you got to pay all the taxes on it. And some people, though, will still say that even if this goes to zero, if it can do it slow enough and they can get enough dividend out of it, that the dividend will more than pay for the cost of the stock. But that's just a break even. Why would I do that? I need to be, unless you really want to get into the nerd of the math and all that kind of stuff there, just stay away. Just forget about it. unless you're willing to YOLO. You know, YOLO, you only live once. You only live once, YOLO. Meaning, if it goes to zero, you don't care. You know, would I put $100 into it? Yeah, fine, I'll put $100 into it. I don't care. If I lose $100, I'm not going to cry. Would I put 10,000? No, absolutely not. All right. So you got these huge dividenders out here. All right. What about bonds? Well, there's all kinds of ways to search for bonds. I'm not going to have time for it. I've got to clear the air here. There is a growth plus dividend. You can do this. I'll show this one over here on Stock Rover. Let me just show you the screener real quick. This is not an exhaustive actually, it's pretty good. Let's take a look at what it says. Price to earnings less than 30. I don't want something that's way too out there. It has at least broken even over the last 6 months. Grown 5% over the last year, 5% average growth over the last 3 years, and over the last 5 years. It has a dividend of at least 2%. Last year and projected this year. $1 billion company, 3-month average, 100,000. I have excluded from here foreign and real estate again, just because I just don't want to mess with real estate. So I've excluded real estate and foreign stocks. And I've created this little thing right here called the dividend trap that says that when you take the return and you subtract the dividend, it better be greater than zero. That's what I was just talking about just a moment ago, of the things that the dividend is greater than, the return can be less than, it can be losing money, but the dividend is still greater, and it shows growth. I mean, it shows a positive return. We don't want that. Okay. Now, did I get results? Yes, I did. And here are those results. And we'll just sort it and kind of zoom in a little bit on it. Get that out of the way. You know, and you know, if any of you want this list, just send me something. I'll be glad to post it to you. Things like SCHD, I added manually to this list. VIG is added manually to this list. That's the reason it's got an X to it, because I was bringing it in to make sure it is included and everything's comparative. But there are here stocks. Now, this is a stock screener. Unfortunately, with Stock Rover, you have to run this, you have to craft they don't have an all-in-one screener that does ETFs and stocks. You have to run it on the stocks, and you have to run it, change it a little bit to run it on the ETFs. Different than Thinkorswim, obviously. But these are all companies that have shown growth, and they have a dividend. Now, it's not necessarily a lot of growth, but they have dividends. So, and a lot of people are saying move to dividends in 2025 because we're not expecting a lot of growth and we may have this huge pullback, blah, blah, blah. So definitely something that you could add these to your list if you want to. So there's, you know, there's a couple names in here that you may recognize. Kinder Morgan, I've heard of them. Don't know much about them, but Main Street Capital. Main Street Capital is I believe they lend money to people with bad credit. Altria, that's Philip Morris. Well, actually, Philip Morris is a separate ticker, but Altria in that same group there. Morgan Stanley. One Main is related to Main Street Capital and all that kind of stuff. So, Snap-on. There's Snap-on. Okay. State Street Financial, and so on. So anyway, I got a few minutes here before I'm winding down. So putting it all together, there are ways to create lists of companies that have made money independent of the S&P, and that type of thing there. Finalize your selection. Finalizing your selection simply means to go through and look for entry points. What do I mean by entry points? We talked about that real quickly earlier. You got to have some kind of a strategy. Obviously, you're going to look at the chart. Ultimately, we need to look at the chart. You might start by looking at where it is with its moving day averages. You might look at where it is on its 3-month price. You may just go simply straight to the chart and just say, okay, if I think this particular chart is going to be bullish, I'm going to not count that. That's too far out of bounds. I might, well, anyway, whatever. In recent history here, we've got this. In my case, y'all know I like box setup. So I've got a low, I've got a high, I've got to move back into 50%. In this case here, if I'm going bullish on stocks, I'd want to see a break above this high and then a continuation if that was a stock I was interested in doing. You may be willing to take the gamble at the midpoint. You may, on the other hand, prefer to see where it sits with the moving averages. Now, this actually, YMAX is a bad example because it doesn't have a history. It's just about a year old. Here's AMD, one of our good old favorites. AMD still below its 8, it's 21, it's 50, it's 100, it's 200. Poor old AMD. But notice that we did take out this low right here. AMD is retooling a lot of their stuff from what I understand. I haven't seen the actual reports myself firsthand, but I understand that AMD is retooling a lot of stuff that they're going into pure AI chips. They're getting out of graphics, they're getting out of this, that, and the other. They're going in AMD into AI. Again, I'm not 100% certain how true that is or to what extent, but that was something that I was told about. And so that means in the short term, they're going to have some losses because they're giving up some of their product things that are making money for them in the hopes that the bet in going all AI will pay off for them in the long term. Not a bad idea. Not a bad idea. But at any rate, you may look at this and say, look here, they took out this liquidity. I'm going to definitely keep my eye on this for the turnaround to see if it's going to go and turn around because we just took out liquidity there. All right. So you got to have some strategy of looking for an entry, and then you've got to decide how often are you going to review your holdings. Because long-term stuff does not mean day trade. It means buy and hold. And yeah, do you put a stop on them? Yeah, I put a stop on them on my long-term holdings. And everybody's got their tolerances on that. But day trading is not the same as long-term holdings. Long-term holdings is something you're going to come back and you're going to look at a couple months from now. You're going to tuck them away and forget about them. So anyway, we come up with a list of stocks. We whittle it down, get a couple per a couple per sector, that kind of thing. Me personally, what I mean by this 1X and ETFs here, if I'm going to, say I got 20 stocks, I got $50,000, I don't know, I might put $1,000 in each stock and maybe $2,000 into each ETF or something like that if I'm going to have an ETF as well. So that's just my thinking on it. So that gives you a little bit more ETF there. But the point being, again, we're trying to get to this whole idea of being, that's not what I want. I want that. I want to see an uncorrelated board of things that are doing well. That's what I want. So anyway, any questions before I go? Because I need to clear the channel for Creed if he's streaming today. All right. Well, I hope that helped give you guys some ideas. Um, and, you know, like I said, everybody's got an opinion. This is my opinion on what I'm looking for. Because, like I said, I'm really impressed with this. Well, if I can get it to do what I want. There it is again. Okay, get rid of that one. No, get rid of SCHD. I'm really excited about seeing this idea about being decoupled from the SPX yet growing. That's just amazing. And so, anyway. All right, folks, 2025 is on us. And Happy New Year to everybody there. Thank you for joining. Hope you got something out of it. And of course, if you have questions, you're more than welcome to send me a message. And I hope I've given you some food for thought on maybe ways you can look for your own long-term investments. And we will see you. See, I'm not here tomorrow, actually. I've got commitments tomorrow. So I'll see you guys again Monday. Y'all have a good one. Talk to you later. Marziti signing out.